let's get us started. Let's tuck into some of the meaty themes that we've got taking shape in our industry at the moment. Seems to be a bit of a perfect storm of conditions overshadowing the macro markets, and we want to get into understanding exactly where we sit within mining, junior mining finance as well, and where the opportunities are as well. So if anyone's got any questions throughout, just raise a hand and we can feed those into the conversation as well. But why don't we get us started? I want to talk about this sort of perfect storm of economic instability, the inflation headwinds that we've got going on, the potential bifurcation of the world through this geopolitical landscape that we've got, and how that's really hitting our industry whilst we're continually trying to maintain an ESG lens to everything that we do and where we invest and the commodities that we invest in, etc. So John, why don't I turn to you and get your pearls of wisdom on this quite challenging market that we see ourselves in at the moment. But what's the headline view that you've been covering in your research with investors?
No, I think that works.
Yep.
Yeah, there's a lot going on. In fact, I'm tempted to say a lot going on as always, but actually the news flow was quite quiet for a while earlier on this year. The problem when you have a banking crisis is not a lot of people talk about it to start with. It's kept behind closed doors within the banks. I know they talk about lots of transparency and all that, but they really do keep this stuff as quiet as they can and hope that it goes away. And of course, like all good problems, it's not quite going away. But we are very fortunate in the mining sector in that we are a key part of, well, we are the supply chain for the battery metals industry. Not just electric vehicles, but the whole electrification of and greenification of power supply. So in some respects, the mining industry carries on as per normal and can perhaps forget about the banking crisis. But unfortunately, on the other side of it is, we have to be very aware of where money is flowing. And without wanting to talk for too long, the market has gone from net long not long ago to net short, but that's what all the hedge funds are doing. That's what a lot of investors are doing. In the meantime, the real world is just carrying on regardless. Now, the problem with the banking crisis is, yes, it can spill over into the real world. There is a very real fear and threat of that. Although the positive side, as we saw last time in 2008, was there was a lot of stimulus and liquidity pumped into the system in reaction to that and as a result of that. Now, I don't think history is going to repeat itself in exactly the same way, but history will repeat itself in certain elements. So, yeah, I think what we're seeing is I would describe it as more of a speed wobble in the sector at the moment rather than anything else.
And what's your view on the banking crisis? Is it sort of the banks that were badly geared up? Read about the capital controls around SVB Bank, for instance, and how leveraged they were. Is it sort of, it's not fair to say that all banks are in the same category, really?
Well, I don't know if it's a question of leverage so much as they had a mismatch on their bond portfolio. And we've all been learning about how banks mix and match their bond portfolios to meet the liabilities and that they're holding. There was an expression that really came out of that and was "go woke, go broke."
Yep.
But actually, that wasn't their real problem. Their real problem was they just weren't managing their risk in the right way. And in the same way, First Republic Bank, I think, had a similar issue in that they were effectively profiting from buying short-term bonds rather than long-term bonds. And the value of those short-term bonds fell because of the new influx of US longer-term treasuries at relatively higher prices. So, look, I'm not a big expert on this, but we've all had to learn it rather quickly. Yeah. Those are local banking issues. Unfortunately, there's probably a few more banks that have done the same sort of thing, and it is an unfortunate consequence of interest rates rising in the US in the way they have. But those banks were profiting out of that, as far as we can see. And so they've come a cropper. but the authorities are dealing with it, which is great. Now, there is always potential for a bit more of a bank run. There is always potential for, shall we say, foreign actors who are no doubt merrily shorting some of those banking stocks to try and perpetuate that crisis. I'm more hopeful than that. I think that some of these sell-offs should be bought. And I don't think it's going to have that big an impact on the mining sector. Having said that, in the mining sector, banks are not featuring that hugely in lending. Money is coming in from other sources, from traders, from huge, large-scale manufacturers. There's more sources of finance in the mining sector than I've ever seen before.
Okay. Yep. Amanda.
If we're going to start sort of at the top with macro, you've got two things. You've got, on one hand, what's unarguable at this point, which is a very long-term secular higher demand for metals. Everybody knows that, and everybody is scrambling. It's where all these new the traders, everybody wants to figure out where they can get a metals supply. But on the other hand, you do have these serious macro factors, and the three of them that are seriously affecting people right now are the fear of recession, inflation, and let's start with the first two. Nobody moves when you're anticipating recession. These bank failures, it's not that they're actually relevant to our industry or most industries. They were relatively small. It's what they might presuppose, as in, are we going to have another recession? And you've got pundits sitting on the fence. It's 50-50, maybe higher than 50-50, that there's going to be a serious pullback. And if that's the case, it makes no sense nobody wants to do anything when a recession might be around the corner. They know that in a recession, things go nuts. Liquidity, nobody lends, liquidity dries up, nobody puts any money into equity, there's deals to be had. So that fear of recession means most people, whether it's the equity investors or the debt investors, which keep our industry going, are sitting on their hands waiting to see what happens. Because yes, in 5-10 years, there's going to be a massive undersupply of metals and it's going to be a great bull market. What's going to happen in the next 6 months is what most investors care about now. On the second part of that, there's inflation and how that's affecting, how that's affecting everything, inflation and rates, which are kind of correlated. You've got a recession around the corner and you have massive inflation and cost inflation, and the inflation might be 10% in the general market, but anyone who's actually looking at mining has been looking at anywhere between 25 and 50% Capex blowouts. And nobody knows how much it's going to cost to build tomorrow's mine. And on top of that, with rates where they are, your cost of capital has just gone up considerably. So between recession fears, high costs of capital, which everybody is hoping will come down eventually. Nobody wants to finance at these rates, and Capex inflation, which they'd like to see under control before they actually break ground. What you have is a perfect storm for people to say, yes, I know metals are going to be, by 2025, 2030, we're going to need twice as much metal as we now produce, but for the next 6 months, I'm doing nothing.
Yep.
And I think that's the issue from a macro perspective, and at least in my opinion.
Even a really attractive gold price isn't going to stimulate things.
Gold's different.
Yeah, it goes the other way. But okay, yep. Bernard?
No, from my side, not to repeat too much what has been said, because I think all the points have been covered, especially about banking crisis. Fed has to keep the rates higher, so likelihood of recession increases. For the inflation bit, I mean, there is a point whereby we're starting to look at oil prices kind of, drop, gas prices, at least in Europe, much more under control than the market had expected even a few months ago. So for inflation, at least the point of view would be that it does, the growth in inflation kind of slows down compared to the 10-12%, but it's a technical base. You're comparing year on year inflation. So obviously if last year was like 12-13%, it's unlikely for it to be that much this year. But I think there is another point also worth mentioning that will have an impact long term. It's all the story of the Inflation Reduction Act, the European response, how Japan looks at it. And that is having, or is going to have a big impact on the mining sector. And if we are going to look at, opportunities, there are rising opportunities in Europe right now when it comes to mining, and this realization that to achieve energy security for the West, we need to accelerate the energy transition. And to accelerate, because that's the only way, we don't have fossil fuels in Europe at least. So basically the only way we can do is to accelerate the energy transition with wind, solar, recycling targets, mining in Europe for critical raw materials. So there's this big realization, which I think will be a positive boost, at least for metals in general.
Yep. So looking beyond this sort of 6-month blockade and massive risk period that we've sort of identified, structurally, it's very positive. But let's get into that a little bit around this geopolitical sort of divide and how the sort of political line seems to be that the energy transition is going to get built. It's going to happen no matter what. But how much is there a disconnect, and how much are these sort of strategic policies helping? And then perhaps let's talk about the way that supply chains are aligning to a sort of a Western hegemony, or a Chinese reopening, or a sort of BRICS type structure as well. Do you have a view from that?
Yeah. So quite a bit to talk about here.
Yeah.
But basically, this realization, COVID lockdown. So basically, the realization that supply chains rely so much on China, and that we need to reshore some of the manufacturing, at least some of the strategic manufacturing. B, the Russia-Ukraine war realization that, that we need to secure our energy sources now in Europe. Although you could argue that in 2010, with the Japan-China island conflict, that was also a realization that, rare earth minerals need to also be secured. But I think that was a kick in the teeth for the Europeans and the Americans to accelerate it. So the Americans started with the Inflation Reduction Act, but the collateral damage of the Inflation Reduction Act was somewhat Europe, because we started seeing investments that were supposed to be in Europe, like for instance in solar panel investments for phase 2, for making those projects bigger, actually starting to head to the US. Apparently something like 12% of the Inflation Reduction Act's total investments so far have been what would have been European investments.
Right.
So Europe being very slow, always in playing catch up because of the complexity of the European Union, has now only in the 16th of March or in February come up with a response to the Inflation Reduction Act. What does it mean for mining? It means that they want that 10% of the consumption of strategic raw minerals that are consumed in Europe to be mined in Europe. You could argue which one is realistic, which one is less realistic. But that was like, for instance, for lithium. Lithium is considered a strategic raw mineral by the European Commission's definitions. That will receive a boost.
But have they done the geological audit? What's the resource
that's
availability
where
in Europe, and how quick can
there
these
are
come
things
to?
where they could reach 10%, for instance, with lithium, with some of their nickel in Scandinavia. So basically Scandinavian countries that are rich in mineral resources.
Yep.
There's the flip side of it is, like for instance, rare earth minerals, which are also part of the SRM, strategic raw materials for Europe. But is there really the will and also the knowledge that China has in refining it? Because I mean, a lot of the refining of rare earth mineral, you end up with a little bit of kind of radioactive wastes going to the sea. I mean, is there the will or the appetite for that? There are some other minerals which are a little bit unrealistic, but generally speaking, yes, it's realistic. They want 15% of their consumption of strategic raw minerals to come from recycled content. So together, 15 plus 10, that's 25%. And they've also said they don't want to have more than 60% of any critical raw material coming from one single country, even if that country is a friendly country.
Yep.
So there's a lot happening in Europe right now. From our side, from the bank's side, we are seeing much more interests from private investors in investing in some of those projects. And the big promise of this CRMA Act and the NZIA Act is an acceleration of permitting, and it's the idea of having a one-stop shop place where you can go to, which was a big attraction of the IRA, basically.
So competing policies are really trying to hook the gigafactory developments and everything.
Yes.
Yeah, Amanda, did you want to comment?
So if I can jump in there, I've looked at the European Act quite closely, and while I don't think it's a bad act, I'm actually headed to Brussels to talk with them on policy making next Monday of all times. But there are some fundamental realities that are missing in that. 15% from recycled sources by 2030 is great. I agree, it should be that if you can get it there. But we're talking off of a 0% base right now for critical minerals and lithium. That's how much we recycle at this point in time. And that means that you have to build basically 15 times more capacity than we've got at this point in time. And you have to permit all of that. These lithium mines, these nickel mines, very few of which exist. And yes, they've streamlined policy making, but they haven't changed the unfortunate fact that in Europe, we need critical materials. We definitely want manufacturing, but anytime someone goes to permit a mine in Europe, it tends to fall down at the local level. The local opposition to it is so high, they just can't get by. There are some exceptions, Scandinavia, a couple mines that exist in Spain, but even Rio Tinto couldn't get through Serbia. As much as I think the European Act is actually an incredible step in the right direction, I'm not sure that the other structural issues with mining in Europe are something they can get over. If they can permit and build and finance that much recycling, that much primary capacity, that much refining.
Yeah, I mean, I see your points. It's true that for recycling, there are some, again, with recycling, with mining, there are some things that are realistic, some things that aren't realistic. Lithium, everyone's starting from zero. But for instance, copper, 55%, which is 55% of copper in Europe is recycled copper. So, I mean, they can reach for nickel. They're likely to reach it. The permitting thing, the interesting thing I find that's different in the tone this time than in previous times, by announcing that these are strategic raw materials, the tone is very different when it comes to the permitting. So they've put very strict deadlines about by when we will give an answer. And the second point I'd make is from a local perspective, yes, there's always the problem of not in my backyard issue, but also by announcing that there are strategic raw materials, they have a bigger leverage on a local level, at least in France, to try and enforce things that before that announcement wasn't really possible to do. So I would say these are the 2 points. I mean, we've looked at it, and yes, there are a lot of things that are unrealistic for them to achieve. But generally speaking, I mean, it's a step in the right direction. It will encourage mining. It is debatable, whereas they'll reach the targets by 2030. They have a lot of problems, for instance, in Europe, if you look at different angles aside from mining, but like gigafactories or decarbonizing the industry, is power. Okay, they want to decarbonize steel production using hydrogen. That's like 45% decarbonized by 2030. If they want to achieve that, they will need, at least in France, 14 more nuclear reactors to do that. So the question is there the appetite in Europe right now to build nuclear power plants? And the other problem also you see about it is that they're pushing for the energy transition, but they're forgetting that it's electrification and electricity power that is needed behind that. So So yeah, I mean, there are a lot of problems, but
it's clear that Europe isn't going to be able to do this alone, though. It's going to need the resources from sub-Saharan African projects or Australian mining
probably
projects.
Like for green steel, the answer, not to go too much off a tangent, but the answer would probably be getting DRI from Brazil or some hydro-powered green DRI and using it in steel manufacturing in Europe. If the other problem is the majority of steel, or the biggest producer of steel in Europe is Germany, and they're 30% of their energy production is on coal.
Yep.
If I could step in,
produce hydrogen from coal. Yeah,
I'm a bit of a fundamentalist when it comes to these things, a mining fundamentalist, just to make sure you're clear on that. When it comes to Europe and recycling, it's all about how do you do it in a green manner. They don't want you to put up pyrometallurgy smelters all over the place. So we've had quite a lot of discussions with companies looking to do this, and they're all looking at a mixture of pyrometallurgy and hydrometallurgy, which is a much cleaner option. Then we come down to what's your source of material. Now, you mentioned with copper, there are a lot of European copper is recycled already. Well, that's a very long established supply chain. If you need more recycled copper, there's a bunch of guys who'll go and steal it off a railway somewhere. And the same with certain other metals as well. But when it comes to lithium, there isn't that much lithium out there in the market just yet. Camcorder batteries were relatively small things. Okay, there's a few 100,000 or maybe even 1 million Tesla cars running around, but their batteries are relatively young. And in fact, their batteries are lasting longer than expected generally, unless you hit a road hump at the wrong speed, of course, because you mustn't damage these things. But when it does come to recycling, it's knowing where your material is going to come from. If Volkswagen says, please set up a recycling factory, that's a great idea, but they're not the guys that get the batteries back. The guys that get the batteries at the end of the day, the insurance companies and the braking yards where the cars end up, for example. So it's very important to understand where these are going to come from. And yes, they will start to fill up to add into the supply chain, but we're a long, long way off recycling in the rare earths and the lithium and those specialist materials coming through. And then when you come to things like carbon for the batteries, most of that gets burnt off anyway. That's just that's what happens in a pyrometallurgical process. So the other thing on the fundamental side is, yes, loads of solar panel production might head off into the US and out of Europe, and it's important the policymakers try and get this stuff right. But remember, you're competing with the Chinese, and in certain cities in China, they produce solar panels with zero power cost because that's their incentive. They say you can produce solar panels here and create lots of jobs and whatever, but your power is either zero cost or near zero cost, and that's really hard to compete with anywhere in the world. So it'll be interesting to see how the IRA and the Americans in general adjust for that. I mean, I guess it's with tariffs, because yes, it's a good idea to have more solar panels. I see at the conference today we've got Solar Century are running around talking to people and presenting. So it'd be very interesting to hear more about how the mining industry is adopting that. But we are increasingly seeing solar being built into feasibility studies.
Yep.
I might just sort of bring Rob back in. The sort of original question we started with here was, what are the macro headwinds, recession, inflation, cost of capital, and how are they affecting, with the IRA and other European acts being pro-mining, where are we seeing the disconnect? Or at least that's where I brought it forward. And I would say, I think the IRA goes the European Act is absolutely a step in the right direction. But the Americans, I think it's a less well-worded act. It's less well thought out, but it has the one thing behind it that the European Act doesn't, and that's money.
Yep.
There was one thing I would say about this is that the big difference between both, one is a tax credit, and one is seed fund. So the US is tax credit. So once you produce, let's say, your gigafactory, your batteries, whatever you produce, I will give you 35 or 40 kilowatt hour in terms of your battery as a tax rebate. And that's great if you're a well-established gigafactory producer, if you're a Tesla or a VW. The European way, the money is there from previous acts like the Repower EU, etc., where the money hasn't been spent. The reason why the money hasn't been spent is because basically it was a bit complicated to access that money. So they created another act to follow up with the other act, and the third act to make it simpler, to catch up with the IRA, which is very simple. The way the EU one works is that it's at the setting up stage. So you come and we will share the equity, and I will put 30% as European, and you will pitch your project, and I'll put 30%, let's say, of the money in. And that's great if you are a company that has no historic existence. So one is kind of attracting new companies or startups into that field of battery manufacturing. And another one is great in terms of if you're already an established
and maybe also a bit protectionist in that the US is very much combating that China in the supply chain. I think the credits are only available if you're sort of North American aligned in terms of your value chain.
Yeah, the European one doesn't tend to be protectionist in a sense where it says you will only get your lithium or what's so from free trade agreement countries. Yep. But what's interesting is that we recently saw the Europeans and the Japanese, who were upset with the IRA, agree with the US about doing kind of like sourcing together, buying from each other critical raw materials. The only way it's kind of protectionist, the EU, is by saying like we won't get 60%, more than 60% of this mineral from a specific country.
Source. Okay, Rob, let's bring you in here. Tackling a lot here on the macro, but what's your view? You cover a number, all the mined commodities within your funds. What's your interpretation of the market at the moment in terms of investing, but then also some of these key drivers around policy changes and shifts that being positive for our industry?
Yes, I mean, so a quick one. So IRA was my view was sort of very much a protectionist view with a clear eye on China. I think the European response is very much in response to the IRA, as they're seeing sort of industry head towards the US, and I'd kind of simplify it in that sense. I think there's a bit of a scramble to try and sort of protect industry. I mean, there's obviously been a bit of a kind of we've seen anti-mining, anti-industry kind of policy, and they suddenly realise there's a real shortfall, and they've got these sort of clean energy targets to try and meet. But we can apply that across all of the mining industry, really. I mean, we've seen this kind of ESG kind of policy, and that's driven by politics, that's driven by shareholders, and it's just led to a complete lack of any new supply kind of coming through, lack of new investment. We're seeing the majors continue to be focused on sort of dividends, buybacks, just because the optics of it are much cleaner than trying to put money into anything, any new big projects. And sorry if I'm kind of rehashing stuff, and apologies for being a bit late. But yeah, I mean, we've had sort of Rio and sort of blowing up caves incidents, and they're even more cautious. So the majors are just heavily pressured now by pension funds, mutual funds, kind of very heavy ESG policy, and that just leads to constrained supply. And I think this is a theme that plays out for a decade plus, right? Because there's no kind of shift on that. So then the other flip side of it is obviously the demand side, and we're kind of here talking to sort of green policy, EVs, electrification, and then that adds another layer of another driver to demand. So I think it's pretty constructive. Amanda sort of helped feed me in there with a bit of the macro views. Clearly we're in pretty uncertain times. We don't know kind of how this is settling out. We've got this whole kind of de-globalization thematic going on, which is clearly protectionist. That in itself is kind of inflationary, and we've got probably the most anticipated recession ever, which hasn't quite fully materialized yet. So yeah, there's a load of sort of moving parts to it, but yeah, I feel like I've rambled on.
No, that's fair. I think one of the comments was like certainly in the 6-month view with the banking crisis and these other trends you describe, making investments now is everyone's sort of cautious or pausing, but longer term structurally it's pretty good for our sector. When's this? When are we going to see an inflection point or things kick on or how do you view it, as a fund manager?
Yeah, so it's commodity by commodity. So we look to copper, and it's very easy to get very bullish on the sort of longer term thematic. We see that playing out. But if we do hit a recession, clearly white good orders can drop off a cliff. We're kind of seeing that, some weak import data into China today. So it does kind of flag there's, it's not all completely rosy on the sort of reopening side. Then you look to lithium. Lithium, the demand growth is sort of off the charts clearly, but then we've kind of seen a bit of a slowing there. It's quite interesting to see sort of Chinese lithium prices collapse well before we've seen European prices then come back more recently. They do seem to be sort of forming a base, and it's that kind of real offset. I'd argue lithium definitely is not rare. There's a lot of it, and projects can be brought on, generally delayed. I think Sigma Lithium was the first one I'd actually seen that actually come in on time, on budget. There's just those two moving parts to it, and then when you've got those kind of extreme moves, even a relative miss on demand, clearly BYD probably doesn't get enough airtime because that's the biggest driver of it, and largest EV manufacturer in the world. One thing we're quite closely focused on is like battery tech. So kind of seeing where that's transitioning. So we're kind of seeing the Chinese launching a couple of sodium-ion batteries, which there's probably people better qualified than me to talk about this. But that could be a complete game changer because all the inputs are effectively cheaper. It doesn't need lithium. It doesn't need. Some of them do use nickel, some do use cobalt, but there's different techs, and we're kind of watching how that transitions through.
Is it going really quick, or is this a sort of a 2030s piece once the lithium-ion batteries had its heyday?
There's always going to be a place for both. Lithium batteries were clearly designed to be lightweight. That was the primary reason for it. So, they're not ideally suited towards grid storage, although, given that's where most of the investment has been, that's where we've seen it rolled out in the likes of Australia. I think to be honest, I think grid storage is probably the biggest issue that the world needs to solve. So, we can keep loading renewables on, but then you just end up with unstable grids. And you see that in Germany, where you have negative power prices 3 times a day. You've seen it in California, where they've had blackouts, and we're seeing more and more risk of that. So, I think that battery grid storage side is probably the key thing. And then obviously that kind of ties into to hydrogen as that kind of longer term storage. So I don't think there's one fix for it all. I think you've got to kind of layer those solutions over each other, and you have some that are quick response, some that are medium time response, some that are longer term.
If I was going to jump in there, I think the problem with the situation right now is there's a whole lot of factors that are converging. You have some I think Europe and North America, the West generally, has realized we need more metals. They've acted with a policy response. I'm not sure that policy response, a plan never survives, hitting battle. There's a lot of other headwinds coming against the plan to invest in critical minerals. An anticipated recession, high interest rates, inflation that's affecting Capex. But in addition to that, there's little stuff. Like nobody quite knows what's going to happen when the European carbon pricing mechanism, hits everything we're doing. I think that's one of the many things we haven't figured out what's going to happen. And I actually, credit where credit is due, the European Union for the first time said you can't just deny permitting forever. And there's a mechanism upon which European projects can say no. But you need to see you need a big example of someone being able to wade through the permitting quagmire, something like a Rio Tinto getting Yadar permitted, something like that. Before people are going to say, wow, Europe's open for business. You're going to need to see a low carbon producer of something seriously incentivized and get funded fully into production. We need some examples to show that any of this legislation really has teeth.
Yep.
It's my opinion.
Okay.
Just following on from something here, you've mentioned a couple of times that inflation in the mining sector, and in fact, go back to beginning of 2020, we didn't really have any inflation in the mining sector. If anything, we were heading into a little bit of a recessionary environment. And then COVID hit. And then a year after COVID hit, which created its own disruption, Russia went into Ukraine. That caused a massive problem in terms of sourcing and the costs for capital equipment for mining, particularly for new projects. The Russians were pumping out quite heavy duty mining machinery that was helping to depress prices even lower. In fact, they were cheaper than the Chinese in many cases, and suddenly they got taken out of the market with sanctions and their own supply disruption issues. So mining Capex went up quite a lot, and in fact became very uncertain. So the guys who planned these feasibility studies just jacked the prices up yet again. That thankfully now is all beginning to settle down, and hopefully if the Ukraine war can finish quite soon, that will settle down even more. But it made it very difficult for banks to come in. I'm not saying that banks are financing a lot anyway right now, but it made it very difficult for those guys to come in, and effectively stalled quite a lot in the mining sector, along with one or two other issues. So I think that's one point to cover. The other was we were talking about China, and perhaps the Chinese aren't buying quite so many washing machines right now. We said for a while when China relaxed the very strict lockdowns that they had, that they would have a lot of COVID that would run round. I think they've done a fantastic job on suppressing the news of that. And of course, the mortality statistics are just not available. Of course, as we've seen in the West, after everybody's caught COVID, everybody seems to catch the latest version of flu going around, and no doubt a whole bunch of other viruses that I think we've all been through, and it's very easy to forget. I mean, COVID now seems like a bit of a long lost memory, but we are seeing the ramifications of that, and we know that traders are not selling a lot of copper into China right now. So I think the world is still working through all that, but what will happen is things will pick up again, almost certainly in the second half, if not sooner. And hopefully we'll just skirt the edge of a recession in the US. The market is definitely looking for the Fed to start to relax interest rates at some point this summer. That seems to have been delayed slightly because of some more recent inflation numbers and the banking crisis. But who knows? I think if anything, that the market is definitely looking for a relaxation there, and I think happy days will come again.
Excellent. We've smashed the macro topics, but we're fastly running out of time. I want to just talk about the miners and the companies as well. Could we focus in on the majors maybe a bit and just talk about what's going on there? Rob, you made some good comments on sort of how they're heavily pressured at the moment by the funds that hold them. The ESG point, the dividend point. Let's talk about Glencore looking at sort of restructuring or hinting at restructuring Teck and the merger there. Are we going to see huge portfolio diversification amongst the majors in this energy transition, and is that going to lead to sort of renewed pools of capital looking at large cap miners and then eventually trickle into the juniors, or is that a bit of a dream at the moment?
Yeah, well, a couple of things to go at there. I mean, anecdotally, just on Rio, I mean, we're hearing they've stepped back quite aggressively from their kind of exploration activities, especially in Oz, because of all the eyeballs that are on them. Following incidents there. Glencore coming in for Teck. I mean, I think that just kind of, again, reiterates the kind of effective valuation on the market. I still think in many cases it's still cheaper to buy than build. That uncertainty, around inflation and the cost of building projects kind of remains. So clearly we're seeing a preference there to buy. I think Glencore's approach for Teck was probably a bit more was quite opportunistic. I think Teck's coal share there kind of obviously had it kind of marked down probably a couple of multiple points or so versus where it would have been otherwise. But that's probably the near term cash flow, and the real prize would have been copper, which is kind of the longer term one, which is just very difficult to find and very difficult to buy on any kind of scale now. And if you do try to build it yourself, then you kind of see these continued capex overruns, which even Teck are having with QP2.
Yep. Anyone else commenting on the majors at the moment?
I think whilst Rio might have pulled back, and they would naturally be quite quiet about what they're doing with their ventures department in terms of exploration spend, others I think are pushing forwards. Anglo American have taken another step forwards with their deal with ARC Minerals for exploration of copper in Zambia, there's definitely there is stuff going on, but they just don't talk about it such a lot.
Yeah, I mean, they've got an issue. They've got a huge pipeline they need to backfill because they've underspent on exploration for a long time. And we've seen them going through, as you say, through that kind of 9.9% kind of ownership, strategic position to try and backfill that.
I would also, there's this constant thing in the mining industry where you know where demand's going to be, and you know that we know we need to secure it 5 or 10 years in advance because it won't be in production for 5 or 10 years. But that makes it easy to delay decisions. And right now, I mean, I've spoken to a lot of guys at both Anglo and Rio right now. They're all desperately trying to decarbonize their existing portfolios. It's a major priority for them. And there's only so many places where they can keep their priorities right now. And I also agree with Rob. Right now, it seems a little bit easier and potentially more risk adjusted to buy than build. And that's a problem for the junior sector.
Yep. Okay.
Just a quick note that I would add is on the demand side, yes, we know where the demand is going. And one of the problems, I guess, with the majors is the past few years, they've been focused more on dividends rather than growth. I mean, the last cycle, they got burnt out. So the focus from shareholders now is we want dividends, we don't want growth. And the other part of it is also rates were so low that you wanted dividends. The problem with that in that, we know where demand is going, but it's like we need to push the supply through growth. And my concern sometimes, that's an extreme case, but you end up in a situation where countries end up having to nationalize or to give a kick so that growth takes place. And the other point also, that's slightly off the tangent, but I was thinking about maybe growth in demand, is that problem is we have here is that demand is linear. And we know from cycles in supply that it's more like a staircase. So you're going to end up with those cycles of too much supply, not at the right time, then supply just flatters and then new project comes out. So there is a lack also in the market of for the, let's call them not the newer metals, but the less well-established metals, which are going to be the superstars. We don't have the right capital markets products that are there to be able to hedge some of them and to allow to reduce some of that volatility. So we know from some of our clients who are solar panel producers, they really want to be able to hedge the minerals that go in. I was like, well, we'd love to help you. You just can't do it.
Yeah.
Can I just throw one thing in there? But I've noticed there's a couple questions. Yeah. It's both a macro and a sort of micro factor. One of the problems with the whole world realizing how important critical minerals are to the energy transition, and the fact that we can see that in 5, 10, 15, 20 years, metals and mining is going to be a more important sector as we energy transition, is that everybody knows that. And we're seeing the resurgence, unfortunately, of resource nationalism. I'm watching what's going on in Chile very closely. It's kind of like half of us who have been through a few cycles knew this was happening again when we saw what happened, like when Mexico nationalized its one and only potential lithium mine. Is this a new resurgence of resource nationalism, which unfortunately puts risk into this sector between the permitting risk and resource nationalism, especially in Latin America? I think that what we're seeing is that people are risk off on juniors right now because there's too many risky headwinds on them. At least that's what I'm seeing.
Mm-hmm. Yeah, so the market's definitely risk off on juniors, but I would kind of flip it the other way and say when you see that kind of nationalisation, it basically limits for new investment into those countries. And you look at Codelco now is kind of seeing negative supply growth despite pretty strong copper production, and then you talk to the lithium privatization, and they're going to go from the second largest producer or something, or might be first, but down to sort of third or fourth. So I think about 35% currently, and they're projected to pretty much stay flat till 2030 as a result. So yeah, it's a bit of a known goal, but then for the juniors, actually that kind of provides more of an opportunity because there are no eyeballs on them. No one really wants to hold companies that have Capex or future cap raises coming through, and we see such a divergence now where you can buy a copper miner on 1.5 times PNAV. And a junior copper with a proper asset will be a mine, not explorer. It's probably expensive if it's on 0.1 NAV relative to its others. So there's a huge split there. The question is like timing, I guess. I mean, when does the market give credit, or does it, do companies continue to trade, come raise effectively, and it's that kind of funding profile to get through and kind of de-risk. But there's a huge dichotomy, I guess, in the market, a split between that kind of junior and large cap sector.
Yep.
I know it's controversial to feel sorry for politicians these days, but I do feel sorry because so often these policies have massive unintended consequences. The unintended consequence of, I'm sure, what was a very honourable policy in Chile was that everybody stopped investing in that area. It's like, let's scrap all the plans today if they're going to nationalise the whole sector by 2030. Thankfully, Chile has a wonderful political system in that the other side has now taken control again, and so the chances of that nationalisation coming through are close to zero.
Yep.
If anything, they might go back towards the original. Well, they still have the original constitution. If anyone's interested, in fact, the great thing about the UK is we don't actually have a written constitution, so we can argue about it as much as we like, but there's nothing actually written down. And this is the problem for countries where they have actually written these things down, but that is another matter. So let's bring on more politicians to disrupt more supply chains, and the rest of us will just carry on getting things done.
Yeah, the scramble is increasingly linked to sort of like a defence mentality, a security of supply mentality, as well as the political ownership. Anyway, we had some questions. Let's get into these. Yeah, sorry.
Well, it's been a very interesting panel discussion. Thank you all very much for contributing, because it's brought up some very interesting macro points. But the thing is that sort of struck me when I was sitting here is that it's painfully obvious that we need more metals, and the majors. Anyway, the majors.
I'll repeat. Yeah.
The majors basically are a little bit hamstrung as to what they can do for shareholder reasons, past performance, whatever. This situation, as we sit today, do you think, because it's so clear that so many of these projects are so attractive, that new players will come into the industry? I'm not going to say it's the oil majors, because they are an obvious area that they could come in to this space, as they did in coal at one point a long time ago. Is it possible that we're going to see additional players come in here? Because I think the existing players are not playing a good game, causing us to be short of the metals that we need to meet the politicians and other people's aspirations in renewable energy, electrification. We haven't got it. We haven't got, these metals aren't available for what the projections, what politicians want, what people here all want. It's not available. So we somehow have to make them available. A lot of projects look very attractive, but no one wants to put money in, particularly some of the juniors, as you say, 0. Some even way less. What's happening? Is there going to be something that's going to break this impasse? And is it going to be new players? Sorry.
Yep, new players.
Can I take a
new
punt
players
at
from
it?
please? Yeah, let's cycle through that.
Yes, but I don't think it's the player you think it's going to be. There's a couple other macro things that happened recently that nobody paid any attention to. In March, BRICS nations overtook the GDP of the G7. So they are now the biggest boys in the room. Girls, I suppose there's a few girls there too. What you saw for metals and mining, what's kept metals and mining afloat during the last super cycle was Chinese demand, and still very important, but then Chinese investment throughout Africa. They are the first buyers. Their money comes with less strings, and they're not scared of mining investment. Now the West has realized, oops, we need manufacturing and we definitely need metals to do all this stuff. And they're scrambling, but they're scrambling with a huge amount of bureaucracy and strings attached. And what you're seeing is, I think the new players are going to come. They see the macro demand coming, and their capital is less constrained. They're not scared of the mining industry, because I don't care what anyone says, the West is still quite scared of mining. They still think, they need it. So yes, we want metals, and we definitely want metals, but here's all the strings we want to attach. I think there's going to be new players, there's going to be new financiers, there's going to be new companies, but the The issue is what part of the world they're going to come from. And while China used to be one of the only other major players, China and Russia, in mining, I think you're going to see the rest of the emerging markets get in on the game. I think Africa has something to say. I think the Middle East wants to play.
Yep. If you think about the Saudi sort of PR press and things that they're looking to wave around. Rob, you want to...
Yeah, I mean, the obvious new player is OEMs. So we're seeing them coming in, taking off-take stakes in projects. So, they can see... I mean, governments are kind of forced down this line because of a sort of political push here on kind of a green agenda. And then, this is kind of ultimately led to sort of IRA and trying to do a bit of catch up in trying to get that supply. But the OEMs are very active now in trying to take stake in projects to secure supply.
But the OEMs are not going to be non, are they?
No, but they can come in and be, 50, 60, 100% of offtake with someone else operating it effectively, owning 50% of the project or providing the capital up front. We've seen that with Thacker Pass, for example, with lithium projects in the US. You've seen the likes of Tesla speculated on Sigma lithium in Brazil.
Stellantis put some equity in. There's some equity gone in as well.
Yeah. So we're certainly seeing that. I mean, it's difficult for other players to come in because banks are pretty tied up because of their environmental credentials, where mining is seen as bad, even though actually it's clearly part of the solution. So I share many of your views. I think they're going to take those passive stakes, the 9.9% type stakes, in more juniors. So we'll see more of that, and they're trying to keep their optionality open should the whole rhetoric and shareholder pressure and board pressure, etc., ease, and then they can get a bit more active and chuck a bit more capital at it. But for the sector overall, this lack of investment is actually great. It's actually one of the best things we could have seen for commodity prices going forward. And as we know, it's many years till we actually see a supply response if people really start ramping production now, or Capex anyway.
Yep.
But I think in answer to your question, in the next 5 to 10 years, if Rio's, BHP, Anglo, and some others don't make more adventurous investments, then they're going to get taken over by the new guys who really are able to supply the battery metals into the industry, the guys doing the lithium, the graphite, the nickel, whatever else is required for the current generation of batteries, and probably even the next generation of batteries, which I suspect will all still be lithium based, certainly in the automotive sector. And maybe for stationary power, who knows what the battery chemistry will be there. Perhaps they will be vanadium redox or some other salt-based type battery. But they will grow into very big players. And it is quite possible if Rio's and BHP just run it for pay out dividends and run share buybacks, they'll just wither and die.
Okay, look, unless anyone's got a real pressing comment to follow on from that. Yeah. Of course, Andrew. We've got a minute.
The assumption here that the green agenda is one that can't be not cancelled but deferred. I mean, nobody's against it. It's a question of effecting an orderly transition which doesn't create unacceptable price consequences, cost consequences for consumers and businesses in the West, and is probably unattainable with current technology and current resource supply constraints. It's a question of deferring. If we're serious if it's such a rush to decarbonise, it's very obvious what the first step has to be, and it's stopping China building coal-powered power stations. It's decarbonising China. It's stopping the increment in China, not reducing the mote in our own eye. It's the huge, great carbon beam in China and some other major economies as a priority. And then we can work on the transition over time. What we actually need is a moratorium on this, or a deferral and delay, not a cancellation, so that we can handle it in an orderly, cost-effective, practical way. Because at the moment, we're just heading for a collision between green dreams and hard reality, whether financial or physical.
The very scary thing is the Chinese are building more solar, more wind, more hydro than anyone else on the planet. They'll be the ones turning off their coal-fired power stations.
About 8, 9, 10 years
The reason they've been building more of them is to fill their supply gap. But the problem, when they start closing those down, their power prices will drop, and their power will be mainly nuclear, hydro, and other renewables. And it'll be even harder for the West to compete with the Chinese, which is quite a scary prospect from our perspective.
Just 1 minute. 30 seconds, and then
Sorry. Yeah, I guess to answer your question, the issue here is that there is the concept that a lot of scientists agree with that says if we don't act now, and the deadline is 2050, if we don't achieve carbon zero by 2050, then it's too late. Hence the rush, and it's going to be inorderly, etc. That's the rationale between not being.
Say it's too late already.
Yeah,
It's
but
too late already.
okay, but that's what governments.
Which is China's increase in carbon rather than reducing our own. This country has done more than almost any other country reasonably expected to do.
China will also argue that they have the right to pollute also, just like you had the right to pollute X.
That's like arguing we've got right
Fine, yeah.
okay. We have to move on, but let's continue this in the coffee break. This is going well. But thanks very much to our panel today for setting us off.